would you hold a bake sale to raise money for your high-tech startup out in Silicon Valley? Maybe in a way of speaking. Chuck Jaffe, MarketWatch's Chuck Jaffe is here with this story. All right, Chuck, crowdfunding. This is the buzzword. Explain it to us.
Well, crowdfunding really sort of started with community things and charities, and it was the idea that your favorite bar band wants to make a CD, so if you donate to the cause, well, they'll give you a copy of the CD. And it has expanded to now being a viable way for small startup businesses that perhaps are too new to get bank loans, being able to raise funding basically via the internet. And it was really given a huge boost by the Jobs Act. So come 2013, when they hope to have the rules set and really be able to open it up, this is going to be the new frontier. And the danger, of course, is that it could also be the Wild West, where you're getting fleeced and killed all the time.
Yeah, because as we all know, the new frontier, it was quite the Wild West show, wasn't it? Listen, you were out in San Francisco. You interviewed a few people there. Why don't you explain to us some of that?
Well, I talked to, among the people I talked to, Ryan Caldbeck. He is the co-founder and CEO of Circle Up, which is a crowdfunding platform that launched this week, and it's only really going to be working with consumer stocks. And, you know, he talked about the fact that right now in crowdfunding, everybody's kind of arguing about the rules they want. So why don't you take a listen to some of what he was saying, what he hopes is going to happen with crowdfunding.
Crowdfunding is a disruptive technology because it lowers the cost to participate in early stage investing. But it doesn't change the underlying companies that you're investing in. What it does do is that it gives access. And so what we encourage our investors to do is to diversify.
Yeah, so, I got to tell you, this makes me very nervous when I hear about this whole thing.
Well, his point is, this is actually gets, though, to the idea that this stuff could be a real ripoff. Mm-hmm. Think about it this way. If you heard from your local bar band and you contributed, okay, that's one thing. Now you hear from, say, your barber. He wants to buy the shop in the next town. If he gets it, he gives you haircuts at half price. Then you go from that to somebody who's trying to raise money for a stock, and you're an investor. His point was, of course, Caldbeck's point was, if you invested $10,000 in one, you're much more likely to lose everything than if you invest $2,000 in 5 different startups. And then you talk about what crowdfunding is supposed to be. Here's where he gets into the rules.
Most important, and what we hope the SEC focuses on, is transparency. We hope that the SEC puts into place requirements that these portals give investors the opportunity to ask the entrepreneurs questions and give the investors the opportunity to communicate with each other.
How can investors really see, though, this is legit, though? How can they really do vetting on these businesses, whether it's their friend's bar or what have you? How do you know the money's going to go where it's supposed to go?
That's a huge part of it, because the rules that he's talking about that still have to be written really talk about how much somebody's going to have to give you in information. For example, if you want to raise more than $500,000, everybody's expecting you're going to have to come up with audited financial statements for the investors to look at. And if that happens, well, let's be perfectly honest. These small businesses right now, they don't have audited financial statements. So there's a real question of whether or not that's going to be a barrier to entry or whether they're going to go up and get it done. Let's point out something else that's really important here that people miss on this. One of the reasons why Facebook is going public is that there is a limitation on how many shareholders you can have. It's 500. And as they were a private company, Facebook wanted to have more than 500 shareholders. The Jobs Act opened that up to 2,000. You just heard Caldbeck talking about communicating with each other. Well, if you're Mark Zuckerberg and you're some giant company, you can communicate with 500 or 2,000 shareholders. But if you're Joe the barber or you're, Ma's Baked Goods and you're trying to expand from the local coffee bar to national coffee bars or get your product in Whole Foods, having 500 or 2,000 shareholders that you have to deal with, that's going to be very daunting, and that could put you out of business. So that's the other reason why you're going to have a lot of interface and rules that they haven't made yet. People need to understand, every business is going to sound good, but the failure rate on small businesses is really high. And as Caldbeck said, this doesn't going to change that. It's just going to change the way those businesses get funded, and maybe it's going to change who loses their money when some of those businesses fail.
Chuck, there's obviously a lot of change going on in the capital markets. This is part of it, I think. To me, the big question is this. Is there a problem with companies raising money, or is this just an opportunistic way for some of these platforms, some of these financiers to find a new avenue to make some money for themselves? That to me seems to be the real question.
Well, you just did a segment was talking about some of the bank earnings, et cetera. I mean, let's be perfectly honest. Right now, people in the banking industry believe that they can make more money by not making loans than they do by making loans. So if you're a small business person, you're high risk, there's no way that the banking industry wants to touch you. So this is really, get it out of the realm of the charitable stuff and the, funding your favorite bar band, and get it to the business side. This is a real viable way of alternative funding. And remember too that this is basically venture capital. And the big problem is that the venture capital firms, until you've got X amount of experience and maybe 10 million in revenues or more than 10 million in revenues, they don't want to touch you. So this becomes a way that you can have micro venture capital for those smaller companies. Let's be perfectly honest. It is going to be very dangerous, and a lot of people are going to lose money. That's why that whole idea of go diversify. And you're going to see stuff like this is going to come to you from your Facebook page or your Twitter account, or hey, check this out. The same way those charitable pitches and other stuff come to you now. But yeah, I think it's actually going to ultimately be a viable way of funding if they can root out the frauds and the problems. Because if they can't, then this is going to wind up being a place that nobody wants to go. It's going to be like penny stocks.
God, it sounds so risky to me. It just doesn't sound like
it should sound
a sharp
risky.
environment for the average, let's just say the average investor.